Today I'm going to compare covered call ETFs. Which covered call ETF is the best performer? So I've got about around 10 or 15 options here. You can see them all listed here. So I have JEPI, but it's the JP Morgan Equity Premium Income ETF. DIVO, or I say DIVO like the band, but it's DIVO, I guess. Amplify ETF Trust. Please press that like button and subscribe. I release content every week. Amplify CWP Enhanced Dividend Income ETF. Then I also have the newer JEPQ, JP Morgan NASDAQ Equity Premium Income ETF. Then I also have this company, this other company, Global X, has like 5 or 6 of these. So I have the S&P 500 covered call, the S&P 500 covered call, and growth. The G stands for growth, I think. So you'll see that some of these here have the D, and then some of them have the G behind it for growth. So I have the NASDAQ 100 covered call. Then I also have the Global X Funds Russell 2000 Covered Call ETF. I have NUSI, which is a ETF series solutions nationwide risk managed income ETF. I have King, which is the CBO Vest S&P 500 Dividend Aristocrats Target Income ETF. I have Invesco Exchange Traded Fund Trust S&P 500 Buy Right ETF. I have another Global X one. It's a Dow 30 Covered Call ETF. I have a Wisdom Tree S&P 500 Put Right Strategy ETF. I have 2 closed-end funds from NUSI, the S&P 500 Buy Right Income Fund and the S&P 500 Dynamic Overright Fund. And then I have the S&P 500 index to compare to, and I'm using Vanguard VOO. So that has the lowest expense. Now the highest expense are these 2 closed-end funds. It's a 0.89% expense ratio, and then 0.6 for DJIA, and then there's one here, 0.75. The cheapest ones, other than Vanguard doesn't really count because it's not a covered call, but JEPI is 0.35, JEPQ is 0.35, and DIVO, Invesco is also fairly reasonable at, well, I shouldn't say reasonable. It's 0.49, so it's one of the cheaper ones. And DIVO is 0.55. Now all of these I've picked only the largest ones mostly, and by large I'm not being too picky. By large I mean maybe 100 million or so. Now I did find some that were like 30 million. I didn't pick those. This is probably the smallest one here, 50 million. I probably shouldn't have even included this, but I just got carried away, I guess. Here's another one that's 95 million. 66 million. And a lot of these, if you look at the date of inception, some of these are brand new, like 2019. Here's one 2007, but you've got some that are 2022. So it's going to be difficult to compare some of those. Anyways, let's get to it. All of these pay their dividends monthly, except for these NUSI ones, BXMX and SPXX. They pay it quarterly. And then there's 2 other ones. The Invesco one right here, PBP, the Invesco one, does it quarterly. And also the Aristocrats one, KNG, this one here, this one also does it quarterly. Covered call writing is the act of putting stock shares up for rent for a period of time. Think of a house that you own that you put up for rent. When an interested renter comes along and rents the home out, then the transaction starts. The renter can live in the house for the time specified. If the neighborhood rental prices goes up above agreed upon price, the tenant is free to rent the house out, to sublet the house to someone else at a higher rate and pocket the difference. If the rental price fails to go up above the agreed upon price, the renter makes no additional income and still has to pay the rent to you regardless. In either case, the call writer keeps the income. In the worst case, the call writer gives up some additional appreciation and sees an opportunity loss or a limited upside. Okay, let's get to it. First, I'm going to do the 3-year performance, and I'm going to do it without the dividends included. So this is just the price of the ETF. It doesn't include the dividends. So this would basically be if you're just collecting the dividends and not reinvesting. So the first one you can see here in orange when I highlight this, that's JEPI. And this is the 3-year performance. So what you see here, this is how much JEPI returned over the 3-year period. DIVO did very well. They performed 18.41%. You can see it's number 2. There's only one that's higher than that. So I'll just scroll here and you can see as I highlight these, JEPQ, this is kind of a new one, so I'm not being too picky about it. Some of these newer ones don't really count for the 3-year. This one lost 19%, the XYLD, which isn't very good. It's near the bottom of the list. This one lost minus 28%, QYLD. RYLD, that's near the bottom. So this Global X so far, they're not doing so well. NUSI is one of the worst. Look at that, minus 24%. It looks like second from the bottom. And we go further to the right. You can see VOO return did a respectable 24% return, because that's a fairly long period of time. And this doesn't include dividends. So once we start including the dividends, you'll see that it does better than that. What are the best performers for the 3-year without dividends? Number 1 is Vanguard. It is, you can see it right here in green, 24.28. Number 2 is DIVO. DIVO is 18.41%. King is number 3. King is 14.29%. What are the worst performers for the 3-year? The worst performer for the 3-year is QYLD. This one lost minus 28.3%. That's quite a bit. Minus 28.3%. NUSI was number 2, minus 24.6%. RYLD was number 3 at minus 22.8%. Now I'm going to look at with the dividends reinvested. So the 3-year with dividends reinvested. Look at these returns. They're quite a bit different now. JEPI's got 39.65%. You can see it here in orange near the top. DIVO, you can also see it near the very top. Now some of the other ones, they didn't do quite as well. So you can see here some of this Global X ones, they're kind of in the middle to the bottom. RYLD, NUSI did bad again. KNG did pretty well. Now this one doesn't invest much in options. It's only got, I think, 7% in options. The rest is just stocks. Okay, so this one doesn't really count because it's too new. It started in 2022, so I'm not really going to include that one. Okay, so the total return, Vanguard is the one of the higher ones. It's got a 30.48% with the dividends reinvested. What's the best performer? The best performer with the dividends reinvested is JEPI. You can see it here in orange at the very top, 39.65%. DIVO is number 2 at 38.56%. And then VOO is number 3 at 30.4%. What's the worst performer for the 3-year with dividends reinvested? Once again, it's NUSI. NUSI always seems to be near the bottom. Minus 5.39% return. That's with the dividends. So even with the dividends, you're losing money. QYLD. Like I said, I left the 2 short ones at the bottom off because they're too new. So the next worst performer is QYLD at 3.55% return. And then their growth one is the next worst performer at 6.74%. Okay, now let's switch to the 1-year performance. Okay, now the 1-year performance, the best 1-year performance with the dividends not reinvested. So this is just your dividends collecting in the account going uninvested. The number 1-year performance is BXMX at 1.52%. You can see it here in blue. Number 2 is DIVO. DIVO had minus 1.06%. King had minus 1.10%. That's number 3. Number 4 is SPXX at minus 2.73%. And if you look here, it actually had a big spike right here. The thing that's a little bit remarkable about it, it's got this big increase right here. But it pays its dividend quarterly, so I'm not sure if that's the reason or it's the way that the dividend would have been paid around right around here, December 3rd, I think. So I think it's just their strategy. It just did well for that period of time. Okay, what's the worst performing 1 year? Once again, NUSI is the winner as the worst performer. You can see it at the very bottom, minus 21.52%. The second worst performer is JEPQ. You can see it here in purple. Now it didn't go, this one was started in 2022, but the price chart is available from I'd say about 80% of the way, so I'm including this one in there. Minus 16.16%. The next one is a Global X one, QYLD at minus 15.69%. And the next one is XYLD at minus 14%, minus 14.2%. The thing that I noticed so far, based on what we've looked at so far, is JEPI did very well and DIVO all around for the other one. JEPI and DIVO did very well. And the one that did very bad was NUSI. NUSI did bad all around. I mean, I don't know what they're doing, but it's whatever they're doing, it's not working. And I looked at these charts to try to find anywhere where they really excelled, and I couldn't find anywhere where, you know, they really went up when the market went down. So I wouldn't invest in that one. Now, one thing I did notice about SPXX that was sort of remarkable is this big bulge here around December of 2022, where it went way up above everything else. And SPXX pays its dividend quarterly. That's one thing I noticed. So I thought maybe that's one reason why it did sort of a bulge above everyone else. This one has 54% invested in options, which is quite a bit. And it also has shorter term options. So the average days to expiration is 16 days versus this one here, their sister or brother company, it has an average days to expiration of 39 days. So this one holds the options for a longer period of time, or maybe they're getting held longer before they get sold. This one, they're getting sold quicker. And that's one thing I noticed. So it just, maybe the strategy worked out well right here. Everything else, I didn't notice anything, you know, too spectacular. But like I said, this one, and if you look here, you can see that the blue here, right around June of 2022, you see that it spikes above everything else. And then you also see the spikes here. And I'm not sure if this is because of the quarterly dividends or their option strategy, but that's one thing I noticed between these two that was sort of different than the other ones. Let's add one more security and see what happens. I've added Schwab US Dividend Equity ETF, SCHD. I've added SCHD to the comparison. Let's see how well it's done. So right now we've got the 1 year. You can see this is just the price return without the dividends. You can see SCHD is near the top, even on the 1 year. Okay, let's go to the 3 year. The 3 year SCHD is number one. This is without the dividends. Now let's add the dividends. With the dividends, now look at this, 48.09%. That's pretty incredible. You can see it's way above all the other ones. Now I see why everybody's talking about this one. It definitely did very well. So let's do another comparison, 5 year. Okay, this is 5 year total return with the dividends. 71.67%. Now JEPI is 39.65 and DIVO is 60%. DIVO is doing pretty well, so it's got the higher fee, but the fee is sort of paying for itself with the returns. Okay, one thing I did notice about NUSI is one of the worst performers, but I did find a spot where it actually did do fairly well. So if you look at this chart here on the far left, if you look at right when the major virus outbreak, when the markets tanked around March, you see that NUSI looks like a bridge almost. It looks like the NUSI looks like the Golden Gate Bridge. It looks like a Golden Gate Bridge going over the dip. You can see how it's way above everything else. And I was trying to figure out why it did very well for this period of time here. It did very well from January to around September 9/1, and it almost looks like a bridge. All the other ones tanked, but it didn't. And I was looking at the portfolio that it does NASDAQ 100 stocks, which are pretty volatile, and they own a lot of Microsoft. Now Microsoft, during it quickly recovered and it went up very quickly, and so I'm thinking that may be one of the reasons why it seems so high here. And they also own Apple. So if we look here at the NUSI pamphlet, it has a 10% 12-month yield, but the thing that I noticed is that it says they don't hold the options very long. They purchase them near expiration. So that strategy may work at certain periods of time, but all in all, I wouldn't invest in this one. Just looking at it, did well for a very short period of time, but you saw how it did the rest of the market. It didn't do so well. I have a couple of more wild cards that I want to throw in here for fun, just to give you guys some ideas as far as dividend investing goes. So there's more than just the standard JEPI and DIVO option. So I'm going to throw in one here and we'll see what kind of results we get. Okay, so I added the Van Ector's BDC Income ETF, BIZD. I'll provide a link to the video on the screen. Now let's see what kind of return they had. This is the 3-year total return. Okay, only 26%, so not so good for that one. Okay, now the 5-year did much better at 61.56%. Now if we look at the total return, and we look at the price return. So look at the 61. Now watch when I change this. Minus 2.39. This tells you that this one all the way up here, there's a massive dividend. They pay out, BDCs pay out 90% plus of their income as dividends. They're required to. So if you're looking for a massive dividend, then maybe look at the BDCs. They're basically junk bonds. It's below investment grade. So the risk is there, but people are aware of the risk because it's junk bonds and it's known. It's not some secret equity linked notes where you're not aware what sort of risk you're going to get. At least you know that this is risky. With an equity linked note, you don't really know what you're dealing with. I'll show you another one that's even better than this. Their top holding was Eris Capital. Now, Eris Capital is one of the largest BDCs. This is the 5-year for Eris Capital. You can see it's not the top performer for just the price return. Watch this 23% when I switch it to dividends reinvested. 94% now. So this 5-year return, this one actually returned more than the S&P 500 over like a 10-year period. So now you've got a 94% return over the 5-year period with the dividends reinvested. And if you wanted to use some of those dividends, it pays a massive dividend. Massive. Larger than all of these. Now let's look at the 3-year. So Eris Capital for the 3-year, just with the total return, it didn't do quite as well. It was 37%, but that's still better than the S&P 500. And you're getting a massive dividend. So it's questionable whether, as the interest rates go up, will these companies that are currently paying 11% interest, variable rate interest, will they be able to handle 15 to 20% interest? I don't know. That's questionable. So these returns may start going down, but it's something to consider if you're looking for a huge dividend. Since JEPI and DIVO did so well, let's take a more detailed look at each. So JP Morgan JEPI has the lower expense ratio. It has a 0.35% expense ratio. It's got the higher SEC yield, the 30-day, 11.15%. For more days out of the year, it's been selling for a premium. So 196 days out of the year, it's sold for a premium. That's 79% of the time. 21% of the time, it's sold at a discount. And the premium can be quite large. The premium, maximum premium was in August 26. It was 0.31%. That's pretty high. And the lowest discount was 0.3. You will more than likely be paying a small premium in order to invest in JEPI. So it says here, it's designed to provide current income while maintaining prospects for capital appreciation. It generates the income through investing in large cap stocks. Now, from what I've read, it's S&P 500 stocks. So they can select from S&P 500 stocks and seeking to deliver income associated with option premiums and stock dividends. Okay, so that sounds pretty good so far. Low volatility equity portfolio, proprietary research with attractive risk reward characteristics. It says here S&P 500 index. Okay, that sounds good so far. The investments they have are pretty conservative. They don't have too much invested in any one stock. The top holdings, Progressive, Exxon, and it's a very small percentage. It's not as high as the S&P 500, I think is 5. Please like and subscribe and press that notification button so that you'll get notified when I put out new content. 5 or 6% for the top one. And they've got a wide variety of different sectors. 128 holdings. Okay, let's keep scrolling here. There's something I want to show you in the bottom here. Under risk summary here, there's some information. Investments in equity-linked notes, ELNs, are subject to liquidity risk. They may be difficult to sell and value. Lack of liquidity may cause the value of the ELN to decline. Well, that doesn't sound good. Since ELNs are a note form, they are subject to certain debt security risks such as credit or counterparty risk. Should the prices of the underlying instruments move in an unexpected manner, the fund may not achieve the anticipated benefits and may realize losses which could be significant and include the fund's entire principal investment. Wow. But of course, if you invest in stocks, you could lose your entire principal investment also. So that could be almost anything. Now they hid this. If you looked in all the pretty charts, they didn't say anything about ELNs. It just says stocks and options. Now let's take a quick look at their prospectus. This is the prospectus for JEPI. Here it actually tells you about the equity linked notes. It says here equity linked notes, selling call options with exposure to the S&P 500 index. The fund's equity investments will include common stocks and ELNs. Now here it says in more detail, the fund may invest up to 20% of its net assets in ELNs. The notes are structured by counterparties, including banks, broker-dealers, and their affiliates. Okay, here's the detailed breakdown of the holdings for JEPI. Now, if you start scrolling down, you'll see all these stocks are very easy to recognize. You've got Progressive, Hershey, MasterCard, and under method, it says physical. Now, if we keep scrolling down, you see one here that says synthetic, equity-linked notes, and it says SP SPX4. Now I believe it doesn't say anything about who created it, who it's from. Then you look down below, it says SPX. I believe this is linked to the S&P 500, but it doesn't say who created it and so on. And you can see there's even more down here. And that's a bit of a concern for me. So that looks like it's mostly just S&P 500 notes. While doing some searching, I did, however, find some more details on these securities. So you can actually look here under the security name, there's more details. So you can see this is pretty up to date. This is February 23rd, and it has a security ID, and then there's a supplemental ID. And then these security names that I said were kind of generic. You can see SPX 1, 2, 3, 4, and there's some more details. Now, I tried Googling each of these, the security ID and the supplemental ID, and nothing came up. So I don't know who created these equity linked notes, whether JP Morgan did it themselves, whether it's Wells Fargo, or who created it. It says right here, security names are structured with reference asset ticker. SPX is in reference to the S&P 500. Okay, now let's look at DIVO. DIVO has fewer stocks and it's got a higher fee. So it only has 27 stocks. It's actively managed just like JEPI, and it's got the 0.55% expense ratio, which is higher. It seeks out high quality dividend oriented stocks along with covered calls on individual stocks, seeks lower volatility, tries to provide lower volatility versus the overall market during times of broad-based market declines. Now let's look at their holdings. Now their SEC yield is showing much lower at 1.87% for the 30-day yield. Just like JEPI, it's selling at a premium most of the time. So in 2021, 234 days it was selling at a premium versus only 18 days selling at a discount. And in 2022, it was more of the same, 208 at the premium, 43 for a discount. The most recent premium for DIVO was 0.19%. That's quite high. And then there's a 0.11% bid-ask spread. So JEPI is much better in this regard as far as the JEPI wins with a 0.02% spread, and the discount, the average premium was 0.13 versus 0.19. And then JEPI also has the 0.35% fee versus the 0.55% fee for DIVO. Now the investments that DIVO makes, it's a little bit more aggressive in some ways. So it's fewer stocks. It holds a higher percentage in each stock. So 5%. Now it's not super aggressive. If you look at Vanguard Information Technology, they had like 40% in 2 stocks. So it's not that aggressive. So it's more conservative than VGT. It's seeking dividend growers with historic dividend and earnings growth. And it has a variety of sectors. DIVO's only 20 to 25 stocks, which are screened to include market cap, management track record, earnings, cash flow, and return on equity. They're invested mostly in healthcare, which is pretty conservative. Healthcare, energy, and it looks like consumer staples and IT. Now here's a holding snapshot that DIVO has provided. This is a bit dated, but this is the latest one I could find. You can see very simple. Verizon, Home Depot, McDonald's, Aflac. One thing you'll notice here, there's no ELNs or equity linked notes. So that's why I think I actually like DIVO better because of that. Okay, so looking back at this again, if we put aside SCHD and we're only comparing DIVO to JEPI, which one is going to be the winner? All right, let's take a look at this. Let's look at the 3-year again. We have the 3-year total return. JEPI, 38%. DIVO, 37.74. That's very close. Okay, we'll do the 1 year now. Which one is better for the 1 year? The 1 year total return, DIVO won with 3.81%. JEPI was 2.87. So I would say that it's a little bit of a toss-up because DIVO won. They were very close on the 3-year, but DIVO won on the 1 year return. And DIVO doesn't have the crazy risk exposure with ELNs, and we don't even know who's providing these equity-linked notes. Everything I've read about equity-linked notes is bad. Lehman Brothers offered them in 2008, and everybody that was holding them lost all of their money. So also, I've read other places that the fees can be very high for ELNs, and I don't quite understand it. I don't know who's offering the securities. We don't really know what sort of risk is involved. So even with the higher fee, I think I would go with DIVO. Subscribe.